If you're young, you'd be forgiven to think that the only thing interest rates do is go up, given the fact that that's what has happened for the last couple of years. But if you zoom out at a longer view of history, you'll notice that interest rates actually go down over a long enough time horizon. And no, the last 40 years of interest rates falling does not count as long term, at least not compared to what I'm about to show you. In fact, interest rates have been falling steadily for over 700 years. That's right. The overwhelming consistent trend for 7 centuries is that interest rates go down over time. And this isn't just one person's finding. This is a well-documented and well-studied phenomenon. This is a chart I found from Visual Capitalist, whereas this is a chart from research from the Bank of England showing the same declining trend over that time period. Here is yet another, and another, and another, and another. And even though you can see from this chart that the average over the last 700 years is 4.78%, you can still see the overwhelmingly obvious decline in the trend for the last 7 centuries. And yes, you can see that across time, there are periods where interest rates rise and fall and go up and down. But across this long-term trend, those only count as short-term cycles. This presents us with a few glaring questions. Number one, why? What in the world could cause interest rates to fall across centuries, across governments, across cultures, across continents, across different financial systems, monetary systems, money and currency types? Why in the world would the overwhelming trend be that interest rates fall over time? And question number two, since we have recently approached zero. And over the last 10 years, there were many currencies and countries with zero interest rates or even negative interest rates. Have we hit the bottom of this trend? And should we expect this trend to stop or maybe even reverse from here? Well, don't worry, it's not actually as complicated as it might seem. If you don't know who I am, my name is Joe Brown. I'm a former stockbroker. I spent years advising the top 1% on how to manage their wealth. And once I made enough money to leave that corporate world behind, I turned my attention to teaching regular people financial techniques that exist outside the mainstream, things you'd never hear from a financial advisor or a broker. So in order to understand what is going on with falling interest rates, we first have to define what interest rates are. Essentially, they are the cost of money. We're familiar with the cost of any other item in life, like if you go to buy a pizza or a burger or a house, we know it costs you this much money to get that thing. But money has a cost as well. It's how much you have to pay to get your hands on that money if you are going to be buying that money. In other words, borrowing it and then paying it back. So the interest rate is the cost of money. Now, obviously, there are different costs of money depending on how you are going to be doing that borrowing. If you are going to borrow money for one night or 1 year or 30 years, you are going to get a different cost of that money. And also it depends on what you're going to be doing with that money. You're probably going to have to pay a little bit more if you're going to be buying chips and electronics with that debt rather than buying a house or maybe even a business. All of these different forms of debt will carry different levels of risk for the lender because they will look at how much collateral there is, how much provable income you have, and really they're just trying to gauge whether or not they're going to get their money back. And the lower their chances are, the more they're going to charge you to use their money. Today we live in a world where interest rates are at least heavily influenced by or sometimes outright controlled by the government, usually through the central bank. Now, for some reason, people today just blindly accept that we should have an entity of bureaucrats engaging in price controls over one commodity, in this case, money, when we outright reject it. And most economists agree that every time you get price controls over any commodity, any service, any good, it distorts the economy, it causes shortages, and triggers domino effects, downstream consequences that many people cannot anticipate ahead of time. Essentially, price controls are a bad idea. But for some reason, when it comes to money, the one good that everybody always uses everywhere, and it's represented on 1/2 of every single transaction, apparently price controls in that case are okay. And apparently it doesn't lead to shortages or excesses. And apparently them in the central bank, those ivory tower elites, in all their infinite wisdom, always know the exact perfect price to place for the cost of money in order to have the perfect economic outcome. In other words, they're delusional. But it wasn't that way for most of human history. For most of human history, the cost of money was determined by free market participants, just like the cost of any other good, simply based on supply and demand. If everybody has a ton of money sitting in savings, it's going to be locked up. It's not going to be being used productively. And in this example, we're talking about most of human history when money was physical gold coins. So if I want to put some of my money to work and I don't have anything I need to spend it on right now, I can loan it out to somebody. And let's say I want to charge them a 10% interest rate. Well, that person may not want to pay me 10%, so they're going to shop around and they're going to ask everybody else, hey, can I borrow money from you instead for maybe 9%? Now, if there are tons and tons of people with a bunch of money in savings, then there's probably going to be at least one person out there who will say, yeah, I'll do it for 9%. Then somebody else is going to say, well, I want that business instead, so I'll do it for 8%. In this case, the supply of money outweighs the demand for borrowing that money. Therefore, interest rates go down. In other words, the cost of money goes down because the supply is higher than demand. Now, let's say that continues and people borrow money a ton until all of the savings have been lent out. Suddenly, savings are very scarce. And if a borrower comes to me and asks for more money to borrow from me, maybe I only have one coin, I'm going to demand 20% to lend it out to him because it's my last one. I really don't want to lend it out unless the profit opportunity is good enough. And guess what? Everybody else has already lent out their money too, so I'm the only lender in town. Maybe somebody else is going to come to me and say, hey, I want your last dollar, I'll pay you 25%. And maybe somebody else comes to borrow from me and says, actually, I want it, I'll pay you 30%. In this case, demand for borrowing money is outpacing supply, and so the power goes into the hands of the lenders, the price goes up. By the way, if you want me to help you apply ideas like this to your investing so you can grow your wealth faster and protect it during times of crisis, click the link in the description below. Now, it's pretty easy to see in a system like this, interest rates are naturally and dynamically adjusting to the supply and demand for that money. On top of that, the interest rate that is set by the free market is actually, in some cases, incentivizing borrowing and spending, and in other cases, incentivizing saving and not spending. Because when interest rates are really high, I'm the only one who has money saved up to lend. And so I get a ton of profit opportunity. That profit opportunity is going to attract other people to say, hey, if I can save right now, that means I get to participate in this profit. So the high interest rate, when demand for money is high and the savings pool is low, it naturally incentivizes the economy to rebuild back up its savings pool, disincentivizing spending and punishing borrowers. On the other hand, if the savings pool is large and not being used productively, that's going to naturally drive the interest rates down as borrowers are able to borrow for less and less and spend for a lower cost, increasing the demand for borrowing and spending, stimulating growth in an economy. Now, if you're wondering what this has to do with the fact that interest rates have naturally gone down for over 7 centuries, don't worry, I'm going to get there. It's important that you understand how the free market influences interest rates compared to the supply of money. Now imagine for a moment that we still live in a completely free market, free economy where people buy and sell based on voluntary association, voluntary exchange. There's no force, and the money supply is finite because it's gold and is not dictated or controlled by a central bank. In this example, let's say the money supply stays completely stagnant. It does not grow and it does not decline. There is a fixed number of gold coins in circulation, and for our example, there's no mining and there's no gold that ever gets lost. One thing that does happen over time though is economic growth. You still have people that figure out ways to make things more efficiently, essentially getting more for less. More food, more clothes, more output, more machines, more places to live, larger farms with more animals. The stock of wealth grows over time. This is evident as far back as you can look through history, that people always figure out ways to increase the total stock of wealth that exists on this planet. That's why we have so much wealth today, so much stuff, because for all of human history, we've found out ways to increase that wealth with innovations and inventions, with ways to access lower cost and more efficient energy sources, going from burning wood for fire to coal to oil to nuclear, being able to harness that energy and being able to power machines to take the place of human and animal labor. These are all things that cause more and more abundance of wealth, of stuff on Earth. But remember, in this example, the money supply is constant. So how can you have economic growth while at the same time the money supply doesn't grow? Over time, you have more and more and more wealth, but the same amount of money. That means you have the same amount of money chasing more and more goods and services. In other words, the money becomes more valuable relative to all the stuff. Or another way to put it is you have deflation. That's right. Over time, for most of human history, we had deflation, the same amount of money chasing more goods and services. This is the opposite of what most of us have experienced for most of our lives, where the money supply growth outpaces the wealth growth. So in our lives, we have inflation, more money chasing the same amount of goods and services. But for most of human history, you have the same amount of money chasing more goods and services, which means prices don't go up, they then go down. It takes less money to get the same amount of stuff. So let's now talk about what that does to debt. If you are in a time period in which prices are going down because the stock of wealth is growing, but the amount of money that exists in the system stays the same, what kind of interest rate are you going to charge when you loan money to somebody? Because today, the way that we look at it is, I'm gonna give you, let's say $100, and let's say I get $110 back from you. I need to make sure that the prices of the stuff that I used to be able to buy for that money for $100 don't go up more than 10%. Because when I get my money back from you, if I go to buy something that used to cost $100, now it costs $120, it doesn't matter if I made 10% from you, I actually lost 10% in purchasing power. But the opposite of that would have been true for most of human history, where I lend you $100, and if I only get $105 back from you, that could be fantastic because maybe the things that used to cost $100 now only cost $99. So I'm making 5% from you in nominal terms, but I'm making 6% in real terms because things are always getting cheaper. When you stretch this out to its extreme, you could get to a point where interest rates could be sustainably negative simply because prices continue to decline. Therefore, if I give you $100 and only get $99 back, that's perfectly fine because the things that used to cost $100 now only cost $94, $93, $92. In other words, when you have a stable money supply and growth of wealth over time, you get deflation. Prices go down simply because people are wealthier, but you are measuring that in terms of the wealth you have access to, not the dollar amount that that wealth costs. And as this process unfolds, interest rates are naturally able to adjust lower and lower and lower because the demand for money is allowed to decrease steadily over time as the total stock of wealth grows. The demand for those units of money is able to decrease because each unit of that money grows in value relative to all the stuff. So when you see this chart of interest rates on the decline on average for 700 years, what you are really seeing is a significant growth in the total stock of wealth that has outpaced the growth of money, allowing the demand for that money and as a consequence, the cost of acquiring that money to also go down over time. Now, in reality, even though for most of human history, money has been gold, it is true that the stock of gold has grown. It's about 2% per year for most of human history because as you might imagine, if the demand for money goes up, then I can either go engage in labor and sell products and services to acquire money, or I can go try and dig some money out of the ground. And so any time that I can spend 1 ounce of gold in terms of money and use that to dig more than an ounce of gold out of the ground, I'm going to do that. But once the demand for money drops because of either an increase in goods and services or because of an increase in the stockpile of savings, now it's gonna cost me an ounce of gold to get less than an ounce out of the ground. Or in other words, it's gonna cost me more than an ounce of gold to get 1 ounce of gold out of the ground. And then I stop mining. So that natural supply and demand for money also sets an equilibrium on mining that has allowed the gold supply to expand at approximately 2% every year for most of human history. That's why when we look at this chart, even though the stock of wealth has grown rapidly over the last few centuries, you don't see a rapid decrease in interest rates because you also have a slight increase in the total stock of money as mining has brought more gold into circulation. So now that we understand the broad brushstrokes here across the long term of history, more goods and services, more wealth, more stuff, lower prices as a result of that growth outpacing the growth of money. Therefore, the demand for money falling, allowing interest rates to fall along with it. The question is, why do we have these spikes? You can see this flat line here that goes down and to the right shows the overall trend, but we also see this volatile line here that moves with the cycles representing the 10-period moving average of interest rates over the last 700 years. And we can see it is pretty volatile, and there are long periods of time where interest rates actually rise. And if we zoom in on a recent period of history from about 1940 through about 1980, we can see that was one of those periods of times when interest rates rose for about 40 years straight. Well, in short, these spikes represent a large increase in the money supply for one reason or another. So even when the entire world was on a physical gold standard, when gold coins were money, you still had periods of inflation. One way you could have that would be locally. If there was a big discovery of a gold mine that was relatively easy to access, you would have a large, quick increase in the money supply as all of that new money made its way into the economy. It would be very similar to the effect that we had from stimmy checks and all the government spending in 2020 and 2021. Bunch of new money enters the economy, bids up prices and services. The same thing would happen if a local economy stumbled on a massive free amount of gold. Now, a lot of people have more purchasing power, spend that money driving prices up. So that is one way that you can have an increase in prices, therefore an increase in interest rates, even on a hard gold standard. A second way that you can have something like this is a new influx of gold from a new economy entering the larger, broader economy in the world. Something similar happened to this when South America was discovered, and a lot of the gold in South America made its way back to Europe, causing a rapid increase in the money supply. Now, situations like that are not very numerous. Most of the time, what you have instead is things like dilution, coin clipping, and currency devaluation, where a government, this happened all the way back to the Roman Empire and probably many times before that, will say, hey, everybody has to turn in their gold coins. And they'll give some reason like, hey, there's people counterfeiting these coins or something else. They're going to say, you give us 10 coins, we're going to give you 10 coins back. All we're doing is melting them down and putting a new image on them. Maybe it's because they got a new emperor or something like that. And we'll give you back the new coins and they'll be worth the exact same thing. What they don't tell you though, is you're going to give them 1 ounce of gold. They're going to melt it down and mix it with maybe a 1/4 ounce or a 1/2 ounce of silver. So the coin they give you back will be the same size, but it'll have half the gold. In this way, the money supply rapidly increases because they diluted the coins and they increased the money supply by 10, 20, 30, 40, 50%. Now they held a lot of those new coins for themselves and they were able to increase their spending that way, but that new money entered into the economy, lifting up prices and therefore causing interest rates to go up as well. Because again, when you have higher inflation, rising prices, lenders need to compensate themselves for the loss of purchasing power. So inflation causes interest rates to go up. Now, most of that happened kind of prior to the 1600s, but once you get around 16 to 1700, you have a lot more examples of things like fractional reserve banking, and then they nationalize it under central banking. Essentially, economies or the government will say, okay, turn in all your gold, and instead of giving you back a different coin, we're gonna give you a piece of paper that says you can come get the gold from us at any time, or you can just use that paper as money. This allows the issuer of that paper to print a lot more of that paper than they actually have metal in reserves, allowing the money supply to increase rapidly, causing the exact same thing. Higher prices, higher rates. And then you get to the modern age since 1971, where the world is on a fiat standard, where there is no solid real money like gold in reserves. You just have the central banks around the world dictating the money supply through pure printing, and there's nothing to redeem it for. So the money supply is 100% controlled by the central governments and central banks. Which brings us to the last question. where are we headed? We are in this era of fiat where the money supply never really contracts anymore. It only expands as a way for governments to take more purchasing power and spend it at will. Does that mean that this 700-year trend has finally come to an end and we should expect only higher interest rates from here on out? Or should we expect this short-term rise in interest rates to be yet another blip on the long-term chart, and interest rates are going to continue heading lower like they have for centuries and maybe even into negative territory? Well, if we're looking at a long-term period of time, I do expect this trend to continue, but that doesn't mean we won't have a short-term period of time with interest rates headed much higher first. If we take a look at the example of 1940 through 1980, interest rates and inflation moved higher for a few decades. The reason for this was very, very simple. The United States government, who controlled the currency of the world, was in a position where they needed to deleverage. The United States government's debt compared to the GDP of the United States economy was at 120%, which meant there was no way the government could tax enough in order to pay for its debt burden. The only way out was for the government to print extra dollars. As they printed these dollars, used that new money to pay for their current debt load, those dollars made their way into the economy, bid up prices of goods and services that increased the value of GDP and allowed their debt ratio for the government to decline down to a manageable 30%. So even though interest rates continued to rise, the government paid for those higher interest rates through the money printer. The money printer continued to push prices higher for everybody else, increased the value of the economy, increased interest rates for everybody else as well, while the government was able to deleverage. As you can see, the US government, who still controls the global reserve currency, is back in the exact same position that they were in at World War II, debt to GDP of 120%. There is no way that the US government can continue to pay for its debt load without an increase in the money supply. If the dollar supply were to stay the same, the US government and all other borrowers would default. Now, in this case, the biggest borrower, the government, is also in control of the money supply, which means they don't have to default if they don't want to. All they have to do is print the money to pay for their expenses. And that is exactly what I anticipate them to do, which would mean we're in for a short-term period of time, maybe a couple of decades, of rising inflation and rising interest rates, just like happened back here from about 1940 through 1980. On the broad scope of history, that is still a short-term blip, and we are probably headed lower from there. I will say, though, that will likely require a return to sound money, essentially a money that most of the world uses that cannot be controlled in its supply by a central bank or a central government. It is that control over the money supply that always leads to these short-term blips where interest rates and inflation rise, even though the long-term trend is down. And that long-term trend being down is as a result of the growth of wealth outpacing the growth of money. And usually the only time that happens is over a broad enough period of history where that control of the money shifts and changes. You get the big booms, the big busts, the economic centers around the world change, and you get the natural deflation that would normally happen. And so if history is any guide, we will return to some sort of sound money. I don't know what that will be. It probably won't be physical gold just due to technology, but it might be some sort of gold-backed system. It might be Bitcoin, or maybe the US government and the Federal Reserve will find religion and decide to stop manipulating the money supply and printing to pay for their debts and do what's good for individuals in the economy instead. One could dream, right? On the bright side, these misallocations of resources cause overvaluations and undervaluations all across markets that represent opportunities to profit if you know what you're looking for. And if you'd like me to help you apply ideas like this to your investing so you can grow your wealth faster and protect it during times of crisis, click on the link in the description below. As always, thanks so much for watching. Have a great day.